IFRS 9 is the main standard dealing with the financial instruments, but it's complex and bulky, and therefore there's another standard, IFRS 7, that prescribes the disclosures or all the information that everybody who has some financial instruments need to write in the notes to the financial statements or on the face. It's not so much about accounting, but about informing the readers. So let's see what it's all about. I am Sylvia of IFRSbox.com, and I help people understand and simplify IFRS. I have created the IFRS Kit, which is the course explaining IFRS in very easy and entertaining way, and it really can take you to the advanced level, plus lots of free IFRS materials, so you're welcome to check them out at IFRSbox.com. IFRS 7 was published in August 2005 with the effective date from 1st January 2007, and it replaced the old ancient standard IAS 30. There was a major revision in 2009 right after big economic crisis started, well, because investors required more information about various financial instruments held by the banks and companies. And finally, as IFRS 9 mandatorily applies from 1st January 2018, also all amendments in IFRS 7 related to IFRS 9 apply. The objective of IFRS 7 is to require or prescribe certain disclosures about the financial instruments in two main areas. The first one, significance of financial instruments for entities' financial statements, which is financial position and performance. So if the entities' financial instruments are material, significant, and how they affect entities' balance sheet, profit or loss, cash flows, or performance. And number two, nature and extent of risks arising from entities' financial instruments and how these risks are managed. So here you're disclosing qualitative and quantitative information about major risks associated with financial instruments, and we'll see that a bit later. Well, who needs to care about IFRS 7? Well, everyone having financial instruments, simple as that. No exception as to type of the entity. But of course, there are exceptions as to type of instruments. For example, disclosures about subsidiaries, associates, joint ventures, insurance contracts, share-based payments, or employee benefit plans are guided by other standards. Let's start with the first part, significance of financial instruments. Here you have to disclose all information to understand if the financial instruments are significant for your financial performance and position. And these disclosures are divided into a few groups. The first one is the disclosures related to the statement of financial position, where you need to show various information about carrying amounts of your financial instruments by their categories, information about financial instruments at fair value through profit or loss, reclassifications, collaterals, and many other disclosures. We will not go into many details right now, as this is meant to be just a summary of the standard. Then there are prescribed disclosures for the statement of comprehensive income. Well, again, you need to show certain breakdowns of gains and losses from financial instruments, interest income and expense, fee income and expense, impairment losses, etc. And also, there are a few special other disclosures related to accounting policies. And here you need to explain the things like criteria for designating your financial instruments at fair value through profit or loss, whether you apply trade date or settlement date accounting and things like that. Then there are disclosures required for fair values, and here you need to disclose the fair values of all instruments, also for those who are measured at amortized cost, because fair values are really important for the users. And then you need to disclose how you determine the fair values, major assumptions and information used, and if you can't set a fair value for some instruments, then you need to describe why. Next, the disclosures about hedge accounting, if you apply it. So you need to describe the risk management strategy, the future cash flows and their timing, uncertainties, and the effect of hedge accounting on the financial statements. So these are all disclosures related to significance of financial instruments. And the second category of disclosures are the disclosures related to nature and extent of risks from financial instruments. Here, you need to disclose quantitative and qualitative disclosures about risks arising from financial instruments, concentrations of that risk, and how these risks have been managed. But first, let's introduce what risks you should report on. It is credit risk, liquidity risk, and market risk. Credit risk is the risk that one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. Simply speaking, it is the risk that you will not collect your receivables because your customers cannot pay for some reason, whether they are bankrupt or whatever. Liquidity risk is the risk that an entity will encounter difficulty in meeting obligations associated with financial liabilities that are settled by delivering cash or another financial asset. In other words, it's the risk that you will not be able to pay your dues due to lack of cash. Well, very simply said. Market risk is the risk that the fair value or future cash flows of a financial instrument will fluctuate due to changes in market prices. And there are three separate types of risks included. Currency risk, that's about the fluctuations in foreign exchange rates. Interest rate risk, about the fluctuations in interest rates, logically. And other price risk that includes, for example, commodity prices, equity prices, and others. When it comes to qualitative disclosures, you should disclose for each type of risk the exposures to risk and how they arise, objectives, policies, and procedures for managing the risk, and the methods that you are using to measure the risk. Qualitative disclosures are nothing else but narrative description, so you're really writing essays about the risks and their management without any specific numbers. Let's speak a bit more about quantitative disclosures, because that's where additional work is, as you have to present certain numbers and calculations. For each type of risk, the standard prescribes own quantitative disclosures. So let's see. For credit risk, you need to disclose mainly credit risk exposures, description of main collaterals and credit enhancements, credit risk management practices, credit quality of financial assets that are not past due and not impaired, like credit ratings, for example. Then information about amounts arising from expected credit losses. And here there's an example of a tabular format of the disclosure about the credit risk exposure and expected credit loss using provision metrics. And that's what you would normally present about your trade receivables. When it comes to quantitative disclosures related to liquidity risk, you need to disclose mainly maturity analysis of financial liabilities with remaining contractual maturities and how you manage the liquidity risk. So please note that the credit risk was about the financial assets that you hold, and liquidity risk is more about the financial liabilities that you have. So here's the example of what you're supposed to disclose. Analysis of remaining maturity, all by different classes of financial liabilities. And when it comes to detail and time bands, that's up to you and your judgment to decide what's the most appropriate. Finally, quantitative disclosures related to market risk are quite difficult and demanding because you need to present sensitivity analysis to each component of market risk. That is interest rate risk, currency risk, and other price risk. And what does that mean? Well, you can do it in two ways. Either you produce basic sensitivity analysis that shows how profit or loss and equity would have been affected by changes in relevant variable, for example, interest rate. So you are simulating the change in interest rate and then you are analyzing the impact of this change on profit or loss and equity. Or alternatively, you can produce value at risk analysis that instead of one variable, it examines interdependence between more variables, for example, foreign exchange rates and interest rates. And it seems that there's a huge amount of work in these disclosures, so let me add a few notes on how to prepare them. Well, you can prepare all these disclosures as one integrated package where one disclosure satisfies more requirements. For example, you can disclose one table presenting both concentration of risk and credit risk. Then watch out the level of detail and materiality. Include all material and significant items, but don't include huge amount of insignificant details because it doesn't help and your readers would be swamped in the sea of useless information. I stress that you should present these disclosures by the classes of financial instruments, and the classes are not fixed and can be different for individual risks based on the relevance. And also remember that the classes are not the same as categories under IFRS 9. Well, in fact, classes are more detailed, they are like subcategories. Okay, so that was the introductory video to learn about the disclosure standard IFRS 7, and if you need to learn more about the financial instruments or other IFRS, go to IFRS Box, see my articles, videos. I have a podcast show where I respond to your questions. You can subscribe to my free newsletter or to my premium course, the IFRS Kit, if you need. Bye, and thanks for watching.